The market marching closer to all-time highs as the busiest part of earnings season gets underway. And our next guest suggests new records could be right around the corner. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, good to see you.
Thanks for having me, Mel.
Still ever the bull. So
Yep.
What brings us higher?
The guys and gals printing the money told you they're going to print more money. Ultimately, the term "don't fight the Fed" comes from the fact that we always come up with these great reasons of why it's right or wrong, good or bad. The guys printing the money told you they're going to keep printing the money, and that means an offensive playbook. And how do you know the pivot point, Mel? And for me, it's when the 10-year note yield makes a low. That's your shift from defense to offense. That happened September 3rd, got retested a couple of weeks ago, and now you're moving higher, which is why trannies, small caps, offense is playing.
So for a while, when rates looked like they were low and could make new low, whatever, a lot of bullish strategists would come on and say, you know what, that's good for valuations. And here you are saying that once the pivot happens in the 10-year yield and it goes higher, that is actually a good thing for stocks. So is there sort of a golden area in which you don't want it to be too high, you don't want it to be too low?
It's more directional than trying to pick a level, quote unquote level. I don't think that levels are as important as they used to be, only except when they hit extremes. And by that I mean you get, for example, is 1.5% the level? I don't know, you broke it 3 times by a little bit. So you could look back and say, yeah, maybe it's anything below 1.5%. But again, what the pivot of psychology that happens is everybody got onto the defensive side of the boat.
So it's the psychology, it's not necessarily
remember,
the
well, this is a human nature game that we try to put numbers on. So our whole bull story for 2019, as you guys all know, was wrapped around weaker economic growth that got the Fed engaged enough to make the long end realize they're going to re-stimulate growth. So what are you seeing in the market PMIs globally? You're seeing an inflection point off historically weak levels. So a lot of the economic data, the 3 things are you got the Fed easing, the central banks globally are just throwing money at the whole thing. And again, forget about whether it's good or bad. It is what it is. The second thing is you're getting an inflection point in the global manufacturing, and you've got a monster demographic tailwind with the millennials peak birth year turning 30. I went to my niece's wedding. It was hysterical. She got married 2 weeks ago, and she had 9 gals in her wedding party, and they're all going to each other's weddings, right? And they're all starting families and doing what you do like I did when I turned 30. You start a family. You start spending money.
Buy a house.
You buy a house. You have 10 years of income verification. At 30 years old, they just cut rates in half. And they're still giving us money. You're in a recession in the consumer when they cut rates, and they're not going to give you money.
I thought they weren't buying houses, though. I thought they didn't care about material stuff like you and I did.
Dude, I was a millennial. All I wanted was experience. 54-year-old millennial, but all I wanted was experience.
Yeah, but Tony, you just said something. You used the R word, recession. So that was what the biggest fear was, recession. You've nailed 18 months to 24 months once the yield curve inverts.
Correct.
As your timeline to still be buying the market.
Correct.
Where are you on recessionary fears? Because the Fed, when you talk about the party is all in the Fed's pocket, they have limited bullets, right? So they can't do as much as you're hoping for them to do in the market's hoping for them to do.
I don't think they have limited bullets, right? The interest yield, the yields just got cut in half. Everybody I know that can is refining. Everybody that wants to buy a house just got a much cheaper mortgage. So you're actually having a stimulative turn coming from all of this weakness. And again, people are so sick of me talking about the 3rd mini recession of the cycle. We're in a manufacturing recession. People are looking for what we already found. We're in a mini recession. Now we're coming out of it because rates dropped so much. You only know that because the 10-year has turned. And that's the sign that you're stimulating growth.
So let's talk S&P 500 for a second, Tony. So, when I think about Q1 earnings cycle into April, the stock market made a new all-time high, and it came in 7% in that from the start, peak to trough. And then we go into Q2 earnings cycle in late July, same thing, new high in the S&P 500, 6.5% decline. We're going to make a new high. You just told us that. We're just 1% or so away from that, but we're going to be in that last week of the Q3 earnings cycle. Why is it different this time?
Again, because the expectations are now finally, Dan, beginning to come down. So here's a myth buster we did at Canaccord. We looked at out-year estimates because one of the arguments is the out-year estimates still have to come down. And we found that in years, this cycle and before, when your out-year estimate was being reduced aggressively, guess what? Valuations expanded and market went up. The 2 of the 3 negative years this cycle, happened when the out-year estimates were actually revised upward, 2011 and 2018. This is all about the money printing. Again, this never ends well. You cannot fix debt with exponentially more debt. It's not going to go good. So the Dwyer doomsday clock has happened. The 210 curve inverted. Now you watch the credit metrics to figure out when it's imminent. Corporate credit is booming. Household debt service ratio historically low. Delinquency rates at the cycle low. It's a hard thing.
So your year-end price target for next year is
Correct.
$33.50. This year it's only $29.50.
Right.
So right now we're above that. In terms of what sectors bring us to $33.50, you're going offensive.
You got to go offensive. Well, let's forget my opinion. Let's go with the history of what happens when you bottom the 10-year. Financials, industrials, consumer discretionary, and cyclical tech lead. In both cases. So in both cases coming out of the mini recessions in 2012 and 2016, you were up roughly 20% when you made that low in the Treasury yield. So the low in the market happened. Market rallied 20%. Treasury yields made its low.
Right.
Went up an additional 30+% each time, led by offense. So, I'm not going to chase the target higher. It's silly in 2 months to try and put a valuation on it. But I'm focused on $33.50, and I think it's going to be front-end loaded. And if that's right, I'm very conservative for next year.